There was. Came down, nice reaction, hit it again, little bounce below it, but now we're snapping back above it. So if we see a nice little intraday higher low developing, good price action, that would be a good signal for the start of a possible reversal, and look for a little trade there, man.
I do see that, which is why I'm going to check out.
That's why I'm gonna check. He's like, I'm good for the day. I see it. I might be interested in taking it, but I'm done for the day. Yeah, it'd be nice if we even saw this 5-minute push and break that prior high. That'd be nice. And then start to see a nice little pullback, higher low, good price action, be able to trade this second leg to the upside. That'd look nice. So that's what we wanted to see on ES. That's something we were discussing is, hey, if we get a nice push back above that zone and we break that prior 5-minute lower high, that's a leg to the upside. And so we have a leg to the upside. We have this swing low, swing high, and this was a higher high on the 5-minute. So this is your first leg to the upside. So once you identify first leg to the upside, what's the first strategy that comes to mind?
Leg number 2.
Leg number 2. So yeah, when you see a valid first leg to the upside, most of the time, what do we see? Nice, healthy retracement. We put in a higher low, and we start to push, and we see another higher high. And that is the second leg to the upside. So we call this the second leg long. We've identified the first leg. All we need to do is wait to see how it retraces, how it pulls back, if it's healthy, where we have some confluence, see the higher low building with good price action. And if we see that, we know we want to get long for the second leg long. So we already have an idea of visually what would we want to see. And then also, based on the setup, what are our like go-to confluences, right? Am I going to use the RSI as a confluence for this trade? Like, is that a popular indicator to use to validate entries on the trade? No, RSI is not really going to help us, right? But what's something that will? Fib retracements, right? We got a leg to the upside. We can definitely connect that leg with a fib retracement. Boom. That's a popular confluence. So again, now I'm thinking, here's the setup, here's the strategy. Visually, I know what I want to see. And then what are like the most popular confluences that I would use to help identify the best entry point on the setup? So then I just got to go through and do my TA and identify where is the entry on the trade. Let's do it. All right, we got the leg to the upside. So let's go ahead and put the fib retracement on the leg. Boop, just like that. And if we keep pushing higher, all we have to do is just readjust that fib and connect the high. So right now, that's where the fib is. But if we move higher, we just continue to drag the fib up and readjust it until we start to see the pullback. And then we'll have a defined swing low, swing high. So right now it's tentative. We will have to adjust it. So already you got to adjust it just a little bit more. But we're already starting to get an idea of where we could pull back to. What do I like to see? 50% pullbacks, ideally. So I'm already starting to take eye of where that 50% level is in that golden pocket. And what do I notice is sitting right there around that 50% level in that golden pocket on the 5-minute. You guys notice anything on the 5-minute there?
Man.
Yep. We see this rally on a 5-minute, base, rally. So there is 5-minute demand sitting right there. So we're going to go ahead and mark up that 5-minute demand zone. And then we want to go through and, see how strong that zone is. Remember, there's 5 things that we're really going through. All right. Did it have a breakaway gap? So basically, did we gap up and then impulse? No. We opened at the same area that we closed. So there's no breakaway gap. We can't check that box off. Next one is the candle body less than or more than 50% of the candle's entire range. Well, we could see it's right at 50%, if not just a little bit less than 50%. So the candle body is right at or slightly less than 50% of the candle's entire range. We can check that box off. Awesome. How much time was spent? Like, how many basing candles did we have? 1 basing candle, little time spent. We can check that box off. Did we break the oppositional leg, the oppositional high of the leg in? Like, did we break prior highs? Well, yeah. Rally, base, rally. That rally breaks the prior 5-minute high. We break the oppositional leg. We can check that box off. Was the impulse 2 times greater than the size of the zone? Well, just go ahead and copy and paste that zone. Put it on top of the other one. Was it at least 2 times greater out? It was. So we've just checked off 4 of those 5 criteria boxes to help us, see which zones are more significant than the others. We got 4 of the 5 boxes checked off. That's a pretty significant zone compared to having 1 of the 5 boxes checked off. So we know that's a pretty significant 5-minute demand zone. Awesome. We have a fib retracement golden pocket level sitting right there. Awesome. What else do we have? We have the top end of that support zone. So you're starting to see how all of these confluences naturally are just starting to kind of line up at the same price point where you have demand that meets support, that meets a golden pocket retracement, and all those confluences just line up in this little 3-point window. That's an optimal entry point where all 3 of these confluences line up at the same price. That's an OEP, optimal entry point. So the assessment of entries is pretty simple once you've done your analysis. Where do all of my confluences line up, intersect, and meet at the same price? We're looking right here. Support, demand, golden pocket retracement. So now we know that in this entire region, right, where a trade could set up, where do we think the best entry is going to be? It's going to be in this tight little sliver. So instead of trying to find an entry in a 10-point zone, we're trying to get an entry in a 3-point zone. It'd be a lot easier to nail the entry in a 3-point window than a 10-point window. So we've assessed where the entry is going to take place. It's going to be right around 63.80. That's right where we have those 3 confluences lining up. So now I know where my entry is, so I can grab my long position tool and click it right at the entry point. Bop. First thing I do is I put my stop loss. Where does the stop go? Where do you guys think the stop should go on this trade? With the 3 main confluences we have, where would you put a stop?
Right below demand.
Okay, why?
Well, I figure once it breaks demand, it's just going to keep on going.
So you look at that as, hey, the odds, if we get below demand, are kind of shot in my favor. The trade looks dead. That's where I want to pull the plug, get out.
Yeah, that's what I would do.
Okay. So I always want to make sure there's a reason. Not, well, if it's like one contract, I can give it 10 points of risk to not lose more than $200. That's not how you set stops. You set stops based on the chart. Where's the trade dead? Where's the trade no longer have good probabilities in your favor? Well, based on the technical analysis we did, I would also agree that the trade is dead, that the odds are just really not in my favor if we get below that 5-minute demand zone. So now what's my risk? It only really needs to be 4 points. Okay, so then I go and say, how many contracts can I take with 4 points of risk to not lose more than X amount of dollars? Could be 1 contract, could be 2 contracts. That'll always change how you get positioned. What never changes is how much you actually lose on the trade, right? But as far as how many contracts can I take with 4 points of risk, how much will I lose? And is that within my risk parameters? So yeah, we got the entries dialed. It's a good place for the stop loss. And then we need to assess a target, right? There's 2 ways to assess a target. You can just do standard 2-to-1, 3-to-1, and just drop your target there. Easy peasy. What's another way to assess a target? Looking left. Just looking left. Looking at prior areas of support resistance. Look left. If I look left, what do I see? Well, I see that this prior high is going to be some resistance. So if we pull back into that demand and we get in and we push, look left, where are we probably going before we see more sellers than buyers? Probably that prior high. That would be an area where you'd probably have more sellers than buyers. So there's a visual target. We could see that that would be a realistic area where there would be more sellers than buyers, and that's where price could fall back down. So that's where we want to get out. That's all really trading is if you think about it in simple terms. It's coming in and finding price levels where you expect there to be more buyers or sellers present. That's all we're doing, because That's what moves the market. Buyers and sellers. More buyers than sellers, price goes up. More sellers than buyers, price goes down. So we're just looking based on analysis where we expect there to be more buyers than sellers or sellers than buyers, and we're willing to make decisions to take trades at these areas. So I expect there to be more buyers than sellers at demand. I expect there to be more buyers than sellers at the support level and off that golden pocket retracement. So I'm looking at it like this, is like probably 70% buying activity down here and 30% selling activity. And if that's the case, that's going to drive price up. Cool. I want to get long there. Where do I think price could get to based on looking at the chart where I expect there to be more selling than buying? Well, right here, where I expect there to be more sellers present than buyers. That's why I want that to be my target. So here's my target. What's my risk reward? It's a 5-to-1. It's good. I like that. So it's 5-to-1 setup. You got 3 confluences to take the trade. It's a good trade. Great risk reward. Count me in. I'm convicted. I'm confident. I like the setup. I like the analysis we've done. The risk reward is awesome. I could risk $200 and make $1,000. Am I willing to give up $200 to see if I can make $1,000 on this type of trade? Yeah, I'm confident in it. I'm convicted. I love the analysis we have. I like where everything lines up. The probabilities are in my favor. I'm definitely willing to just give up $200 to see if I can make $1,000. So I'm willing to put on that trade if we get down to the price that I've already predetermined I want to get in at. And the price that I've determined that I want to get in at is based on the analysis that I've done. That's it. So now we do what? We wait. The most fun part about trading is now we don't do anything until price gets there. And then we take the trade. And we may not get there. We may just keep pushing up, pushing up, pushing up, pushing up. We may not get back down there, and that's okay. Maybe we get this quick little ES trade to set up for us. All right. So I'm going to trade options on it. So you guys understand how you could look at ES and still trade SPY options. So what's my risk on ES? 4 points. What's that risk on the SPY? It's 40 cents. So now I know my risk on the SPY. If I did the same analysis and the same plan on the SPY, it's going to be 40 cents of risk. I know the correlation between ES and the SPY. So every 1 point on ES is 10 cents on the SPY. So I have 4 points of risk on ES. That's 40 cents, right? On the SPY. I'm just going to have to get the trade off. We'll talk about the math after the fact, but I don't want to miss the trade. Good setup. And I got to get an order typed up. Let's go. Tomorrow's expiration. I'm going to go 40 delta. If I go 40 delta, I'm risking 4/10 of the delta. So that's going to be $16 a contract. So I'm risking $20 a contract with a 40 delta call. 20 bucks a contract. 10 contracts, $200. I'm cool with that. And we have a 5-to-1 setup. So I got potential to make 1,000. Cool. All right, so we're going to go with a SPY call, tomorrow's expiration, and I built my plan on a 40 delta. The ones we'll be rocking is going to be the 363s. And that's really all I did, is I need to figure out what is my risk on the SPY. Well, I know 4 points is 40 cents. Once I have that 40 cents, I can go look at the delta, and I can figure out what's my risk per contract. So I could still look at ES and trade SPY options, and my risk reward is going to be pretty accurate.
Yeah, for that little bit. I mean, it's not like you're going to sit on this thing for a while. Your 40 cents isn't going to really matter much.
No, we expect, I mean, how long did it take to fall? So 5, 10, 15, 20, 25, 30 minutes, give or take. 30 minutes from this price to our entry. So assess how much time you think you'll be in the trade. Well, probably 30 minutes. 30 minutes down, maybe 30 minutes back up minimum. So if I already know I'm going to be in this trade for probably 30 minutes, am I trading today's expirations? No. Fate is going to eat me alive in 30 minutes at 12 o'clock on a same day expiration. So I already know I'm not taking same day expiration. I'm going to go buy myself time and go at least tomorrow, right? To where I'm okay with being in this trade for 30 minutes and I don't have to worry about the theta eating me alive like a same day expiration would. And I'm choosing my expiration strategically based on what I think my hold time is going to be. I'd say minimum 30 minutes. I want to buy myself some time. Because if we see this go up 5 points, No, it's not 5 points. It's 21 points. That's $2 on the SPY. Yeah, a $2 move on the SPY, you would see those options print. So let's see if we're right. Because here's the SPY, right? There's that demand zone on the SPY. There's that demand zone on the ES. What are we doing? Getting in off that demand zone. All right, so let's build that plan on the SPY and see if we're right. So our entry on ES was off the midpoint of the demand zone. There's the SPY demand zone. That's our entry. Where did we put stops? Below that demand zone. So stop, same thing. Under that demand zone. Where was our target on ES? Prior highs. So target on SPY. Prior highs. And what did we say the numbers would be on the SPY? Looking at our plan on ES, we said 40 cents of risk on the SPY. And we got 21 points of upside. That's $2.10 on the SPY. So these should be the numbers on the SPY, on the plan we just built. Let's go see if we're right. What's our risk? 40 cents. What's our target? $2.20. So we're pretty spot on, weren't we? So you see how you can build a plan on ES and not even have to go look at the SPY and analyze the SPY, but still strategically trade SPY options with not needing to navigate away from ES. And we were spot on. 40 cents of risk, $2.10 of reward on the SPY. We were pretty spot on. We got about 40 cents of risk, and we're looking at about 220 to the upside. That's the plan.
And the other thing you can take a look at is you calculated, you always calculate this on the looking for the second leg, is how long did it take to get down to the entry point, and see if the time frame roughly replicates that same downturn.
Yeah, because we said about 30 minutes. We're on a 5 minute. So we have 1, 2, 3, 4, 5, about 6 candles. So what is that? It's 30 minutes. So it took about 30 minutes to go from here to here. Our assessment was probably another 30 minutes to go from here to here. How long's it been? 5, 10, 15, 20 minutes. So in the next 10 minutes at this pace, we're probably getting there. So our time assessment was pretty spot on.